Hi, everyone. Prof. Gordon here from Exam Success, and we're going to go through this depreciation example. So let's dive into it. We've got a company which buys a truck which costs $50,000, and management expects the truck to last for 4 years, and then it'll have a residual value of 12,000. Okay, so this is all that we're given. And so now we want to be able to calculate, the depreciation. And, we are exposed to different methods, but I'll focus on the straight line method and a declining balance. I'm going to add in a little extra information for declining balance in a minute, but let's just talk about straight line depreciation. So we've got this truck which costs 50,000, and in a previous video, we talked about the accountants dividing the economic life of a business into time periods, 3, 4, and expensing this entire 50,000 in period number 1 when we buy the truck. We said, that doesn't really reflect the true situation of what is going on. This truck is going to provide benefits over the next 4 years. So it's not appropriate to expense it all. What we're going to do is we're going to allocate the cost of this truck over its life. So we'll allocate it over the next 1, 2, 3, 4 years. How do we allocate the cost of this truck? We are going to show each year on our income statement, that statement of comprehensive income, we're going to show a depreciation expense or a depreciation charge. Sometimes they use that language. So we'll have the depreciation in each year. It will be an expense which goes on the income statement. And this expense represents the use of this truck. We're using up the truck. And if we're applying this straight line method, then the carrying value on the balance sheet, what happens to this truck? Well, as we say, it depreciates, and its carrying cost or its book value starts to decrease until it gets to its residual value. So I use this kind of staircase going down so that you can visualize that the carrying value on the balance sheet or the statement of financial position is going to show the cost of the asset less the depreciation expense. So let's figure this out using the straight line depreciation method. Well, very easily, let's put together a formula. So the straight line, the depreciation expense is going to be equal to the cost minus the residual value over the life of the asset. That's the depreciation expense or the depreciation charge each year. So we can figure this out. It's going to be the same over each of the years. That's why it's called straight line. So if we plug in these numbers, the cost of the truck was 50,000. So 50,000. The residual value or the salvage value or what we feel we could sell it for, that is 12,000. So minus 12,000 divided by the useful life. Well, that's going to be 4 years over 4. So the depreciation expense or the depreciation charge, we've got 50,000, take away 12,000, that's 38,000. 38,000 divided by 4, that's going to be 9,500. So every time period, we're going to record an expense of 9,500, 9,500, 9,500, and 9,500. And this is reflected on the income statement. Remember, the cost of the truck was 50,000. So what would we record on our balance sheet? And remember, our balance sheet is done at the end of the time period. So at the end of the time period, the carrying value on our balance sheet will have 50,000 minus 9,500. And so we're going to end up with uh, um, 40,500. 40,500 would be the carrying value at the end of the first year for this truck. What will it be the next year? Well, we will now depreciate this value again by $9,500, and it will be carried on the balance sheet at 31,000. And it keeps depreciating down. So the next year there'll be another 9,500 depreciation charge, and the carrying value, the carrying amount on the balance sheet, the book value is 21,500. And then we carry this down further, and we have the depreciation expense, the last, and it gets us down to the 12,000 residual value. And, that's 12,000. And so, that there it is. There's the process using straight line depreciation. The expense is the same each year. Now, the declining balance method is a little bit different because we need to calculate the amount each year, and it's going to be a little bit different. This declining balance, well, we now have to add some information. So let's just clear this up a little bit here. We'll get rid of these. We don't need any of these arrows anymore. So we'll talk about declining balance, and well, hopefully we can see this color. I'll try to make it a little darker, okay, for us here, okay, and get it in there. Okay, so the additional information. So declining balance, well, first of all, let's just look at the formula. If I wanted to calculate the depreciation expense or the depreciation charge, I need to know whatever percentage it is that I'm writing off, whatever that depreciation percentage is. It might be 25% or 35% or 37. That's depreciation. Okay, I tried to make it look a little nicer there. Okay, multiplied by the cost. What was the cost? Minus the accumulated depreciation, AD. So the accumulated depreciation represents the accumulation each year of the depreciation. So let's clean this up a little bit further, and we will then be able to compare both the straight line and the declining balance. So as I said, the first thing we need to know is, what is this percentage in the declining balance? What is it? Well, you'll be told this in the question. It might be twice the rate of the straight line, or, I'm just going to make it up here. I'm going to say, let's say that we're using 37.5% as our declining rate, our depreciation rate. That's 1.5 times, in case anyone really is keeping track. Okay, so let's calculate the depreciation charge using the declining balance for the first year. So it's going to be equal to 37.5% times the cost, which is 50,000, minus the accumulated depreciation. Well, nothing is accumulated yet. So the first year's depreciation expense will be 18,750. Okay, there it is. So if I put it over here on this kind of timeline here, let's drop it in there. We'll compare it. 18,750. You notice that the declining balance, the value of the depreciation charge or depreciation expense, is much larger than it is in straight line. And so the carrying value is going to be quite different. So in this case, we would have the 50,000 subtract the 18,750, and we get a carrying value of only 31,250. So you're going to have differences in terms of the reported assets, for companies that use different depreciation methods. Okay, that might go a little beyond where we're going, so I'm going to leave it there. Let's go to year two. So for year number two, the depreciation expense or charge would be 37.5% times the cost, which is 50,000. There's the 50,000 minus the accumulated depreciation of 18,750. So now the depreciation charge in year two would be 11,718 and 75 cents. Okay, I'm going to leave off those pennies there. Okay, so we'll say 11,718. 11,718. So now we can see the carrying value at the end of year two will be the 31,250 minus 11,718, and we get a carrying value of just 19,532. You can see that it's depreciating much faster. This declining balance is called an accelerated method. Okay, let's even go one step further. Let's do year three. Okay, I know this is going a little bit beyond here, but let's say year three. Okay, I've got my 37.5%, and now I've got my cost of 50,000, and now I need to subtract the total accumulated depreciation, 18,750 plus 11,718 and 75 cents. Okay, I need to subtract off 30,468. Okay, I'll leave the 75 cents off. Okay, and if we calculate the depreciation expense, it is now 7,324 and 22 cents. Okay, I'll put it in there. All right. So now we can see in year three, 7,324. Okay, now the depreciation expense is under the declining balance is less than it is under straight line. There's a flip. Okay, that concept can take it may go beyond where we're going. But what I want you just to be aware of is, in summary here, when you talk about a depreciation or amortization of an intangible, the straight line method is nice and easy. Okay, we can calculate that straight line depreciation expense or depreciation charge, just the cost minus the residual value over the life, and it is the same for each year. The declining balance, to be able to calculate the depreciation expense or the depreciation charge, here it is. We need this formula. So what is it? It is the percent of decline. So they will tell us it's declining by 25 or 37.5 or 30%. The percent that it's declining times the original cost minus the accumulated depreciation, the total each year, you got to add it up. So then these numbers will be different. It's declining, as its name says, declining. So you can see that the expense is declining. So this will give differences. If the companies are exactly the same, this will give differences in terms of what's reported on the income statement for profit. It'll give differences in terms of the carrying amount. Okay, that term, carrying amount. and the carrying amount is on the balance sheet or the statement of financial position. It's also known as the book value. The carrying amount declines year after year. It's the cost less the depreciation expense. And a straight line depreciation, we see how it's stepping down. Even the declining balance, we could see how it's stepping down, stepping down. I could have continued here, and we get to our residual value. So this depreciation example, it demonstrates how it wasn't appropriate to expense the entire 50,000 in the current period because we're getting a benefit over the useful life of this asset. So we use depreciation to allocate the cost of using this asset over its useful life. So I think this is a good example to get you an extra mark on the exam. Okay, so we'll end this lesson here.